It's brought about like a big conversation around Bitcoin DeFi, around just doing more with Bitcoin than just, peer-to-peer transactions and holding your value in Satoshis. All of a sudden, there's conversations about things like the Stacks environment, which tries to bring more functionality and like sort of Bitcoin DeFi to Bitcoin.
Hello, and welcome to the Crypto Brief, a podcast from the Fidelity Center for Applied Technology. Every week, we get together to discuss current events and trends in blockchain technology, tokenization, DeFi, NFTs, mining, and related aspects of the crypto ecosystem. I'm your co-host, Ryan Stubbe, Director of Bitcoin Mining, and I'm joined by Jason Ward, Head of the Blockchain Incubator, Parth Gargava, Product Architect within Fidelity Labs, and Jack Newwriter, Research Analyst with Fidelity Digital Assets. Before we begin, just a friendly reminder that this discussion is for educational purposes only and should not be viewed as investment advice or a recommendation for any security or asset. The views expressed are those of the co-hosts and not necessarily those of Fidelity Investments or its affiliates. As we all know, digital assets are speculative and highly volatile and are only for those investors with a high risk tolerance. So let's dive into what's been happening recently.
Hey guys, how are you doing?
Hey, I'm good. How are you doing?
Doing well.
Doing great.
How was your weekends?
Busy as usual, but more work than play for me. I don't know about you guys.
Well, I'm sorry to hear that. You dug out from all the snow that you've had up there in the far north?
Yeah, we got a healthy dose. I'm looking forward to taking advantage of it at some point, but didn't get to do it this weekend.
Yeah. Well, hopefully this is like the trend for March, because certainly the rest of the winter hasn't been particularly good for winter sporting. Yeah, I spent my weekend shopping for a couch, which I think I'd rather shop for a car than a couch, if I'm being completely honest. I think like they've like really done a nice job in the car market of just like streamlining the whole process, where you really like all of like the haggling and the negotiation like really isn't a thing anymore, which I guess that's to the detriment of like the consumer. But I think that, like even going like into like these showrooms for couches, like there isn't 500 options to paint a car, really, unless you're buying like a Rolls Royce, I guess, right? But like these salesmen, like they are, and women, they talk about, like how there's 600 different fabrics you can choose from, and for me, that's too many choices. Give me like 4, a white, a gray, some sort of vibrant color. But
at least you don't have to register your couch.
Well, that's true. And I don't think you have to pay like, you don't have to pay like excise tax on it either. So, pay insurance on it. So, but anyway, yeah, I'm happy it's Monday, and I actually don't have to think about that until next weekend when I probably have to make a decision on it. But, anyway, let's jump in. I know we have quite a bit to talk about today. Parth is coming home from a conference, I think, so we won't have him today, but he'll be back next week, and I think he even plans to talk a little bit about he was at ETH Denver last week, so a little bit about what he saw and heard there. But today we're going to start by talking about a little bit about where crypto meets banking and some news that we saw last week out of Silvergate. We're also going to talk a bit about ordinals, which are, unique tokens on top of Bitcoin. People are calling them Bitcoin-like NFTs, and we'll talk a little bit more what that means. And then we'll talk about some enhancements to Ethereum in the form of what they're calling account abstraction. So with that, Jason, you want to just provide a little bit of an overview on Silvergate and kind of what we saw last week with that?
Yeah, I'd be happy to. And it's interesting to be talking about this now, because we see that Silverbank has been one of the I'll call it premier banks that has worked with crypto companies over time, particularly in the US. And they had some exposure to FTX. And now in the months that have followed the FTX bankruptcy, we saw Silvergate come out last week and communicate that the bank thought that they might not meet the deadline for providing some additional data that is due to regulators by March 16th in support of their December 31st financial statement filing. So basically, the bank said, we've got some more work to do. We want to be upfront about that and communicate to regulators and to the community. And the bank also acknowledged that they were undergoing investigation by bank authorities and the U.S. Department of Justice, and noted that the bank was unsure of its ability to remain a going concern over the next year. And when you think about financials, you think of that type of phrasing, ability to remain a going concern, it basically means, will you be able to stay in business? And with that type of uncertainty, we saw a number of their crypto customers or digital asset customers step back from relationships, quoting an abundance of caution. So we saw the likes of Paxos, Galaxy Digital, Circle, Bitstamp taking the step back. And we also saw that Silvergate came forward on Friday and shared that based on a risk analysis and risk-based decision, effective immediately, they were going to discontinue the Silvergate Exchange Network, or SEN, which is a facility that allowed for digital asset companies to transact with each other, make payments 24/7/365. So helped with a lot of the non-banking hour movement of US dollar fiat. And Silvergate also noted in that release that all other deposit-related services remain operational. But if you take a look back, the Silvergate Exchange Network has been a very important catalyst in allowing crypto companies to do business with each other and make these payments outside of banking hours. A lot of folks were able to facilitate movement across different exchanges because exchanges may have had accounts at Silvergate. So just to sort of break it down, what that really means is within the bank's ledger, they could debit and credit value across their customer accounts without needing to use the Fedwire payment rails. So it's more like an internal transfer. And that type of activity was pretty substantial. And I dug into some reporting that Silvergate has on their website. Just to give you context. In Q4 of 2022, the Silvergate Exchange Network moved about $117 billion of transfers amongst its participants. That was up 4% from the prior quarter, Q3 of 2022. But it's actually down about 47% from the same fourth quarter period of 2021, when they moved almost, it was $219 plus billion of value. So seriously, you think about that type of contraction, you ask, what was the customer base like? And we saw, based on Silvergate's own reporting, that as of year end, their digital asset customer base stood at about 1,620 folks. But that was down a bit from Q3. We're still up year over year, but we don't currently know what that customer base on the digital asset side looks like today because of certainly the bank communicating questions about their ability to remain a going concern. But also Q4, we're expecting to report a loss of about $1 billion and more losses in January and February. So there's a question of how much they'll continue to retain that customer base, particularly as they've chosen to suspend the Silvergate Exchange Network. But you might ask, what does this mean? Well, there are definitely some other players who are seeking to step into the void and provide fiat transfers for crypto customers. I know that there's at least one company that has a payments license from the United Kingdom's Financial Conduct Authority. They're currently working on fiat to crypto rails for euros, Swiss francs, and yen in Europe. So they're reportedly looking to accelerate dollars, but there will be other rails. And you may also ask, have we matured enough? Would stablecoins be an opportunity? I think the answer there is yes, but keep in mind that you're retaining some counterparty credit risk to the issuer of the stablecoins.
It seems a little bit like you're going backwards in time, right? this is one of the big things that was noted previously that led to the rise of something like Tether, right? A large stablecoin that lives outside, in large part, the regulated U.S. banking system, because all of these companies had trouble getting access to traditional banks. And to your point that you stated, Silvergate was sort of integral in giving access to banking or banking-like products to a lot of these crypto companies. And the game theory from any single company's perspective, like you sort of said, there were 5+ names over the past week that said we don't have exposure or we're de-risking and pulling our assets. The game theory almost hurts someone like in Silvergate's situation, where if you do have any liquidity issues, they're going to be exacerbated by the fact that I'm going to look out for my own company. And so I'm rightfully probably going to pull my assets from a bank that I think is facing liquidity issues. And that makes their liquidity issues worse. So it sort of compounds the problem. And then I think, Jason, I don't know if you mentioned it, right? But right now, Silvergate and then Signature is the other big bank that's being named as like, those are the two banks that bank the crypto industry in large part. And I think it was in December, Signature had sort of come out and say they wanted to decrease their exposure to crypto. And so it all plays at this issue of like going back in time from getting access to traditional banking payment solutions.
Yeah, I think that's a good point, because if you think about it from a traditional banking services angle, a lot of the banks are able to extend credit because they're utilizing deposits, and the actual liquidity is based on the flow of money. I believe it some time ago, it might even be a different ratio now, but only about 12% of the global supply of money was represented by physical notes and coinage. So when you have a lot more I'll call it digital value that moves back and forth, the question about where that money lies and can you actually obtain that is something that these risk managers are contending with. So they're looking to manage their risks as corporations, and understanding that you're dealing with a fractional reserve system, you have to proactively position your company to essentially retain value and retain access to that liquidity. So I think you're right. It is challenging. But I sort of think about stablecoin for a moment. And if you have a fiat-backed stablecoin that has provable reserves, then you might feel more comfortable with that than worrying about potential counterparty risk from another depositor for an institution.
Yeah, and I just wonder like how this plays with the industry at large, right? As Jack mentioned, this problem kind of dates back to the earliest days of crypto, where it was really hard to become banked if you were a crypto company early on. And with the kind of introduction of Silvergate and Signature and other providers that were kind of crypto centric, right? That improved, but now it seems like we are taking maybe a little bit of a step back. And the question really is where are these people going, right? If they're leaving Silvergate, certainly the larger companies will likely be able to establish banking relationships or have pre-existing relationships with traditional quote unquote banks, right? But this could hurt smaller companies, right? Because we know certain regulators like the Federal Reserve, the OCC, and the FDIC have said to banks, there's been no official change in regulation or regulatory guidance, but have basically said if you're going to interface with crypto broadly, right? And that could be holding reserves for stable coins or maintaining accounts on behalf of crypto exchanges. You need to be really careful and be prepared to have kind of a higher level of oversight, which, no one really, I think, wants that, right? Because of the kind of inherent risks associated with facing these companies and these projects. It kind of is creating a little bit of a squeeze, I think, and maybe in the short term we'll see that, where people are getting pushed maybe out of the banking system or to suboptimal providers in the absence of really good services that are offered from a number of providers.
Yeah, we've talked ourselves about special purpose depository institutions or speedy banks that are being created in Wyoming. We knew of Custodia. I believe Kraken also had set one up. So there are attempts for crypto companies or companies wanting to service crypto to find a positive solution. And I believe in those cases, they're deposit only, not lending institutions. And we've spoken before about Custodia and their goal of obtaining a Fed master account license. So I won't go into great detail there. But Ryan, when you talked about the regulators advising banks on how to manage risk or considerations for how they manage risk associated with digital asset customers, if my memory is correct, there was a proposal recently that would require a bank to hold any crypto deposits or crypto-related digital asset deposits as part of their balance sheet, which would constrain their capital if that were to become a rule that takes effect. So I think we've learned a lot about systemic risk coming out of the global financial crisis. I think there are a lot of folks who are trying to ensure that those lessons are not forgotten. But I think in some cases, a risk-averse approach may lead to other solutions and opportunities for entities that might be outside or managed by different regulators. I mean, we see the European markets and the markets in crypto assets coming forward with more clear regulations. I feel like a broken record every time I say that. Look, if you're in the U.S. or North America, perhaps look to the east. You're seeing a little bit more clarity being given by some of those regulators.
Yeah. No, I mean, this will be something to watch. I think, it kind of has been slowly trending in this direction. And last week, I think, was the first kind of major development. But, certainly we'll have to monitor this. And I know the industry this is an area of kind of ongoing concern, even beyond Silvergate, right? When we think about, crypto and banking. All right. Let's switch gears a little bit. Let's talk tech. So, Jack, do you wanna talk a little bit about ordinals? A lot of buzz around this over the last couple of months, and it seemingly came out of nowhere, but that's not really true, right? I mean, it kind of dates back to the earliest days of Bitcoin. So I think if we could just start by talking a little bit about what it is, and then maybe we could talk about some potential use cases and what the impact is on the network as a whole moving forward.
Yeah, definitely. So I think we briefly touched on it maybe a month ago. There was like a weekend where we started to see these ordinal inscriptions. And then we talked about it at the end of one of these episodes, just as sort of like, hey, this is interesting. Maybe it's a fad that fizzles away or something, but it doesn't seem to be a fad that's fizzling away anytime soon. So I'll give a brief recap of what are ordinal inscriptions, what's some of the things that have been happening over the past month since we last talked about them, and then maybe we can chat about them. So ordinal inscriptions, there's sort of two words there, two pieces being combined. One is inscriptions, which is just embedded data or text that you can add into your transaction. And then ordinals or ordinal theory on Bitcoin is the use of unique numerical ordering of Satoshis that allow you to identify specific sats, which sats are 1/100 millionth of a Bitcoin. The smallest way you can divide a Bitcoin is into a Satoshi. And so we can uniquely identify Satoshis, and we can inscribe arbitrary data or text or files. And so then you combine the two, and you have a file that you can basically save into Bitcoin, and you can link it or track it using a specific Satoshi. And so like if you take just like ordinals on their own or ordinal theory, one can identify like the rarity of Satoshi. So you could believe in the fact that like the first sat ever mined or the first sat after halvings, which are rare, but not as rare as the first sat ever mined. And you can sort of pull this logic through a number of ways where ordinal theory could lead you to believe certain sats are not directly fungible with other sats. It's just a way of like thinking about it. And Chris, our director of research, actually did some research over the past week or two and sort of gave a little internal presentation to our research team and sort of used the great phrasing of like, you can believe in like ordinal theory that certain Satoshis are worth more than others, but it's just a way of looking at it. And you don't necessarily have to believe that, right? One sat is technically fungible with one sat if you go to an exchange, but at the same time, you could look through the lens of ordinal theory and identify certain Satoshis as being more rare or unique than other Satoshis. And then when you combine these inscriptions of adding embedded data, you can create what are like NFTs on Bitcoin or digital artifacts on Bitcoin. And this really came up with the launch of Ord Wallet in December. And now today, if we look back, there's over 250,000 inscriptions on Bitcoin. Most of these are text or images, and we've seen quite a number of inscriptions using ordinal inscriptions over the past month or two. And Yuga Labs, right? Yuga Labs is the creator of Bored Apes Yacht Club. I got corrected the other day when I said the creator of Bored Apes Yacht Club and CryptoPunks. They're not the creator of CryptoPunks, but they own CryptoPunks now, which both are, two of the most, if not the most, prominent NFT collections on Ethereum. They just launched, they're calling it 12-fold NFT collection. It's a 300-piece collection that they just launched on Bitcoin. And so all of a sudden you had something that looked like this interesting fad that might fizzle out right away. You have folks like Yuga Labs coming in. You have Casey Radamore, who's like really the person, sort of like the central figure that many are pointing to as like sort of responsible for some of this taking off. And he's been doing a number of podcasts throughout the Bitcoin space. And it just seems like something that's not going away, and it's only becoming a bigger conversation. And it's brought about like a big conversation around Bitcoin DeFi, around just doing more with Bitcoin than just peer-to-peer transactions and holding your value in Satoshis. All of a sudden, there's conversations about things like the Stacks environment, which tries to bring more functionality and like sort of Bitcoin DeFi to Bitcoin. And again, like Bitcoin makes explicit trade-offs, right? To be intentionally simple. But then you could look at that and say, well, is that just a simple foundational layer that then you sort of put different things on the side of it or on top of it to the degree that it's possible? That's sort of one view. And I think that that's sort of the chain agnostic or use case agnostic view, is like all of these use cases that we didn't think were possible are starting to be created. And some of them are silly, certainly. Like you could look at some of these digital artifacts on Bitcoin and think they're silly. But some of them maybe down the line become really prominent and useful, or people see use in them, and therefore it creates fee revenue for miners and security for Bitcoin. That's one way of looking at it. And then I think the other way of looking at it is like the fundamentalists of Bitcoin, or you could say the true Bitcoin maximalists camp, which would say, did Satoshi write about digital artifacts in the white paper? No, he wrote about peer-to-peer, digitally electronic cash, and we shouldn't have these things competing with the monetary use case that Bitcoin was intended for. So I think it creates this interesting debate that we're seeing taking place. When we wrote our 2022 review, one of the phrasings that our research team for Fidelity Digital Assets used was like, 2022 was kind of a boring year for Bitcoin. Not necessarily a bad thing, but there wasn't that much happening. It was continuing to do what it was supposed to do, and that's great. Maybe that's always what Bitcoin will be. Now we're seeing all of this stuff take off, and it's kind of the exact opposite through the first 3 months of this year.
Yeah, I think for me, being a miner, the kind of implications for the network economics and the network security are the most interesting. Obviously, it's been a really hard, year for miners. And so kind of the possibility of, new monetization strategies via ordinals, I think is very attractive. And it's part of the reason why we've seen some of the miners like Luxor, which operates a mining pool, embrace this. And they purchased Ordinal Hub, which is, kind of like a, I would say like exchange dashboard, whatever you want to call it, that, marketplace for ordinals. I think as we think about the next halving at the, late Q1, early Q2 of next year, miners are kind of staring down, this significant impact on their revenue, right? And when the block subsidy gets cut in half. And so the idea has always been that at some point, as we have more and more halvings, transaction fees will pick up to kind of, fill that gap, in addition to presumed price action, right, and the appreciation of Bitcoin. And obviously, over the last year, we haven't seen the price appreciation piece. So that's concerning, right? And so I think that's what has a lot of people who are proponents of this excited, because it does bring kind of new sources of revenue and new utility to the network that will ultimately, as you pointed out, Jack, benefit the security of the network, continue to incentivize miners to mine on the network, and thus bolster the overall security and stability of the network. So I think it's neat. I think there's a lot of infrastructure that is going to need to be built here. One of the things that I wanted to ask you, Jack, is kind of how does this differ from your traditional, Ethereum NFTs, kind of at a high level? I know there's a lot of technical differences, but
yeah, I don't want to misspeak on anything, but my understanding is on NFTs themselves on Ethereum, there is an added element of trust to the NFT issuer themselves. Whereas, that's sort of one piece. The other side of the coin is there are these large marketplaces that already exist for you to be able to exchange. Now, a lot of them are in a more centralized fashion on Ethereum, like OpenSea. Counterpoint to sort of Bitcoin and what's being created here would be that the embedded inscription lives in the Bitcoin blockchain versus, and I don't know if I'm doing a good job of describing this, maybe I'm underqualified to answer this question, but versus right now, this is completely new. So there's no real exchanges that are set up or taking place. Yuga Labs, even just this morning, is getting backlash because the way that they've launched this 12-fold NFT collection is they're taking custody of bidders' Bitcoin. And then supposedly if you don't win the auction, then you're going to be sent back your Bitcoin, which it's Yuga Labs. Not to say you should or shouldn't trust them, but they're a large entity. In all likelihood, they'll probably send the Bitcoin back to people, but that's probably not a great precedent to be setting. And so you don't have a maturation of true marketplaces. And then also, Casey has sort of talked about this on some podcasts, is you need to really know what you're doing. You need to be running your own node if you really want to be custodying the asset. Again, wallet infrastructure isn't built for any of what's going on Bitcoin.
Well, you could basically spend your NFT without.
Yeah, it's just a Satoshi.
Right? Yeah,
right. So there's probably some way that wallet infrastructure, if this continues to take off, can be built to be able to uniquely identify it and make sure that if you make a transaction out of the same wallet, that it's not spending those specific Satoshis. I don't know if Jason has anything to add that's more intelligent than what I just said.
I wouldn't say more intelligent. I would say I think that you call out a lot of great points. There are other markets that exist today when you have an asset that is fungible but unique. And I would say, even looking at the mortgage-backed security market, for example, you might have a set of mortgage pools that have similar characteristics, but one might be deemed a little bit of higher value because of the underlying loans that it represents. You can still deliver that mortgage pool to satisfy an obligation, but if you unintentionally deliver something of higher value, then you don't have recourse to retain it. There's no cancel rebook to say, I want to give you this mortgage pool as opposed to that. And using that analogy in the Bitcoin space. So yeah, I might have an ordinal and I spend a SAT and I send the wrong SAT and I've lost my ordinal. It's more than just the value of the Satoshi. So I think that's interesting. I will sort of go back a little bit and share my thoughts on what Ryan was talking about in terms of, or you, Jack, you may have mentioned it. Some people are not happy about this application of Bitcoin. My personal view is that it's permissionless. You don't have to agree with it, but I do think you have to accept it. And I was at a meetup recently in Dublin, and one of a speaker, it was a Lightning focused meetup, and the speaker had been a core dev, and he was asked the question from the audience, what do you think of ordinals? And his response was, it's permissionless. It's interesting. Do you want to be principled around the permissionless nature of the network, or do you want to take a position about some uses being positive, some uses being negative? I don't really know, and everyone's obviously entitled to their own opinion, but in my line of thinking, it's possible. It may not be preferable. Possible.
Yeah, Jason, to that point, there's this really interesting conundrum going on, which is, I would say over the past year or two, maybe it was 2 years ago, you started to hear, because of the burn mechanism of EIP 1559 on ETH, Plus, then you combine it with merge, causing a lower issuance rate on ETH. You get the net burn effect, so deflationary supply, and whether or not you want to believe it's ultrasound money or whatever, that was a narrative that started to take off in the ETH community, which was kind of the network was put first to create, complex transactions or whatever you want to call it, different use cases. And then they're backing into this like money property, which is sort of Bitcoin's primary focus and realm. And so that they're like ETH is entering the monetary axis of like looking at a blockchain or these databases. And now Bitcoin is doing the exact opposite at the start of this year. Is there's like conversation from Bitcoin, not that it's losing its core focus, but that all of these other things are now pushing Bitcoin on this axis of like complexity, usability, different use cases, this NFT and artifacts. And so you're seeing like Bitcoin entering ETH's realm while ETH is entering Bitcoin's realm. I don't know how this all ends 5 or 10 years from now, but it's really interesting to see both worlds colliding at the other's, sort of primary use case. When we want to say that they're two different things, which is like the argument that I've sort of used in the past, you're starting to see some of these lines blur between what's possible and what the design of these networks are, even though they are two different things with different trade-offs. And
at the end of the day, like the market is going to decide it, right?
Yeah.
Like just like, like the kind of explosion of NFTs on Ethereum, like that didn't just happen, right? There was a demand, and that kind of Ethereum stepped in or Ethereum-based NFTs stepped in to fill, right? It's possible that I would say fairly possible that we see something similar happen with ordinals, right? And it's really, unfortunately, I know we say this a lot, but like only time will tell, right? If there's sufficient demand, then you're going to see all of this additional infrastructure kind of crop up around it, right? And thus adoption is going to increase. So I think it'll be interesting to watch. I do want to briefly talk about account abstraction, and this is something that I'd want to talk about with Parth when he's back, because it was actually announced at the conference that he was at last week. And so basically, last week at WalletCon, as part of the broader ETH Denver event, the Ethereum Foundation announced the launch of ERC 4337. Which is also known as account abstraction or entry point, which is essentially a series of I would say enhancements that are being deployed on Ethereum and other EVM compatible blockchains like Polygon, Optimism, Arbitrum, BNB Smart Chain, Avalanche, and Gnosis Chain, which kind of unlocks a whole host of new capabilities as it relates to wallets. I think it's important to note that this is being implemented via smart contract deployed on Ethereum, not an upgrade to Ethereum as itself. As we know, with those types of upgrades, they take a really long time. This is coming via smart contract, which was thought to be pretty far away still. And I think came as a surprise to a lot of people. The ETH Foundation basically said that they had completed an audit on these contracts with Open Zeppelin, and that they had passed, and that they were going to be deploying it on Ethereum. And so some of the kind of proposed or perceived benefits of this, I would say really the biggest one is around kind of key management and how we think about seed phrases, and as well as kind of private key management, and kind of abstracting away, no pun intended, a lot of the complexity associated with those I would say aspects of crypto management and crypto transactions, right? So that's the first thing. But there's a lot more beyond those two things, such as being able to kind of have a higher degree of programmability. So being able to basically set up auto payments via a wallet, having two-factor authentication enabled when you send transactions, as well as I think this one is particularly interesting when we think about Web3 and blockchain-based gaming, basically being able to generate like session keys, which would remove the need to sign individual transactions when you're playing these games, and it kind of signs automatically during a particular gameplay. That's really cool, because I think Parth has talked about this in the past, and I've dabbled with it a bit. When you play these games that rely on blockchain, like you're constantly signing if you're using a MetaMask. And it's not a great UX. So I think this is a huge usability upgrade. And now it's going to be on kind of the wallet providers and the different service providers to build on top of it to kind of unlock it for the average user. But, we talk a lot about kind of barriers around usability. And I think there's a tremendous amount of excitement for this. As I said, people were not expecting it to come so soon. And so now I think it's going to be really a matter of kind of what the implementations are with existing and new wallet services. I don't know, you guys have any thoughts on this?
You kind of hit the nail on the head there. We have, not to change the subject, but Shanghai, right? We just got news. Early testnet of Shanghai, which is sort of your last battle if it goes successfully, to then actually implement Shanghai, which is to allow staked ETH validators to then withdraw those assets and pull out their Ethereum if they wanted to. That's happening on the 14th, the last testnet. Then early April is what the indication is, if that goes successfully, of when we could see Shanghai. After that, you've put all of the sort of the merge piece behind you, right? Because Shanghai is really the last piece to finalize sort of the ability to stake and unstake your assets. Now we have, you said, EIP 4337 with account abstraction. We have discussion of EIP 4844. Sorry, I'm not trying to sound like a robot, but 4844 is the proto-dank sharding, which is basically allowing or trying to optimize layer 2s to settle their transactions at a cheaper cost. And layer 2s are a big part of Ethereum's future of scaling. And to me, like 4844, 4337, account abstraction, proto-dank sharding, you start to combine all of these things. And basically, ETH is looking at its next phase, which is all around this theme of usability, making interacting with wallets easier, making transactions cheaper, making this thing potentially scale from, I don't know what it is, 100 million people to billion people, if it's possible.
Yeah, I mean, I think, that's a great point, Jack. I think all focus was on the merge, and then the merge happened, and now people are, thinking about Shanghai and kind of when that's happening. And then it's like, what's the next chapter of Ethereum? And like these upgrades are that, right? And it's, I think, promising to see that there kind of is a roadmap beyond the merge, because I think, there obviously was as a master plan and a roadmap for Ethereum, but I think it's easy to lose sight of when you're in the news cycle and all you're hearing about are these like very specific events. And so I think it's kind of like supercharging the use case for Ethereum, right? And, all of these things cumulatively, I think to the extent that they're, implemented successfully, bode really well for the network, for the next cycle. So it'll be really cool to watch. And I think bear markets are for building. And so, now is the time for all of these different providers to be building on top of these enhancements, so that we can improve, user experience, improve adoption, and, hopefully bring it mainstream.
Yeah, I think that's probably the quote. Bear markets are for building. We definitely are trying to live that ourselves. I would just leave you with one last thought on this whole Ethereum evolution. It's feature functionality. The more that you can integrate additional capabilities, the more uses that you will realize. And ultimately, you need to be thinking about it from a user perspective. So if users are asking for increased throughput, increased scalability, increased privacy, increased security when it comes to protecting and managing your private keys, I think those net positives for the Ethereum community to focus on.
Yep. Yeah. All right, guys. Well, this was a great discussion. I'm absolutely going to put Parth on the spot when it comes to account abstraction and also the difference between ordinals and Ethereum NFTs from a technical perspective. So, stay tuned and come back next week for that. But thanks everyone for joining the discussion, and we'll see you next week. Have a great rest of your week.
Digital assets are speculative and highly volatile, can become illiquid at any time, and are only for those investors willing to risk losing some or all of their investment and who have the experience and ability to evaluate the risks and merits of an investment. Past performance is no guarantee of future results. This podcast was produced by Fidelity Center for Applied Technology, also known as FCAT. AFCAT does not offer digital assets nor provide clearing or custody of such assets. It is for informational purposes only and is not intended to provide tax, legal, insurance, or investment advice and should not be construed as an offer to sell, a solicitation of an offer to buy, or a recommendation for any security or other asset by any Fidelity entity or any third party. Views expressed are as of the date indicated, based on the information available at the time, and may change based on market or other conditions. Unless otherwise noted, the opinions provided are those of the authors and not necessarily those of Fidelity Investments or its affiliates. Fidelity does not assume any duty to update any of the information. Fidelity and any other third parties mentioned in the podcast are independent entities and not affiliated. Mentioning them does not suggest a recommendation or endorsement by Fidelity. This information is not intended for distribution to or use by any person or entity in any jurisdiction or country where such distribution or use would be contrary to local law or regulation. Persons accessing this information are required to inform themselves about and observe such restrictions. Third-party trademarks appearing herein are the property of the respective owners. All others are the property of FMR LLC. Copyright 2023 FMR LLC. All rights reserved. 10